Get Rich Education is brought to you by Mid-South Homebuyers, top-notch turnkey property in Memphis, Tennessee.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education. This is weekly episode number 49, and I'm your host, Keith Weinhold. But who cares who I am? Because you're not here for me, you're here for you. Yes, it's the show where I'm back to help make you more successful than me, faster than me. Can't stop, won't stop. You are bouncing to that sound that says this is Get Rich Education. And with listeners in 138 nations, thank you for making us iHeartRadio's investing show choice. Thank you, too, for your listenership on iTunes, Spreaker, the Android app, a dedicated iPhone App Store app, Castro, SoundCloud, Overcast, Pocket Casts, Stitcher, whatever other platforms I can't think of right now. I wouldn't have even remembered all those if I wasn't looking over at GetRichEducation.com. I really appreciate that you're here, and as usual, I'm going to leave you better than I found you. The U.S. homeownership rate has now plummeted to its lowest level in 48 years. We're going to discuss that. And then, of course, go beyond that to reveal what this means to you, how you can capitalize on the opportunity of an historically low homeownership rate, and as usual, give you some ahas, like making you say, I've never thought of this that way before, okay? And another part of this today is going to be what goes into the renter versus buyer psychology, all right? I want to give you new ways to think about your wealth and always make this show a high rate of return on your time, okay? Well, hey, several weeks from now, I'm getting back on a plane and visiting a couple investor-advantaged U.S. real estate markets. That includes a couple days that I'll be spending in Memphis, Tennessee for a market update there. My terrific wife will be with me. I'm going to get out and see where the market drivers for sustainable rents are. And yeah, while I'm in Memphis, in that market, I'm also going to immerse in that rich Memphis culture. You know, you might as well. It's part of travel and the spice of life. Memphis has a lot of culture. Beale Street, Graceland, the famous Memphis barbecue, the Mississippi River culture, the Memphis Grizzlies NBA schedule that will have kicked off by then, so we might take in a game. So, you know, I just love traveling to markets and reporting on them to you. I mean, I know you just might not have the time for that, but I just make the time for that. I enjoy this. You know, one of my degrees is in geography. I just love travel and new experiences. Okay, I mean, I'm just doing something that I'm going to be doing anyway, so I might as well give you some real estate investing perspective from that market while I'm there. If you would like a Get Rich Education logo decal, you know, I'd really appreciate it if you wrote a review for the show on any of those platforms I mentioned. To get that decal in the mail, just send two things to info@getricheducation.com, a screenshot of your review, and then your physical mailing address so I can send you the decal. And again, just send those two things to info@getricheducation.com. Yes, you'll still get your decal if you wrote the review months ago. Yes, if you live in Ireland, we'll still send you your GRE decal, as one listener asked us. Yes, if you want to give one to a friend that also listens, sure, just tell us and we'll send you two. Now, at times, I need to speak in generalities today. And you know, I could really say that for a lot of shows. Real estate has a lot of it depends factors, and you know, sometimes there are rare exceptions to rules, and if I have to mention every last caveat, we won't get anywhere. The homeownership rate in the United States in the second quarter, okay, like the latest quarter ended, declined down to 63.4%. That's the lowest it's been since 1967, and that's coming straight from the Census Bureau. Furthermore, this decline in the homeownership rate has really accelerated since 2009 and the mortgage meltdown, okay? It's probably just going to keep going lower than this, and we're going to discuss why today. Now, just 10 years ago, the homeownership rate was 69%, okay? And again, it's 63% now. The Urban Institute predicts that by the year 2030, this rental surge that we're seeing now is going to continue and drop the home ownership rate from its current 63% down even further to 61%. Okay? Well, of course, this dynamic is good for you if you own income property. Home ownership is down, and that means more people are renting. Okay? This greater rental demand increases your occupancy and the amount of rent that you can charge. Okay, so low home ownership is good for you if you're in that scenario, okay? Now, let's look at why the home ownership rate has become so depressed, so low, okay? Meaning that there are more renters. All right, now we've already talked about some of these things on the show before, but first of all, lending standards are really tough. You need to have a good credit score to get a loan. Your debt to income ratio limit is capped by your lender. That kills a lot of loans right there. You actually need to state your income to get a loan now. I mean, crazy concept. Imagine that. Sheesh, 10 years ago, you know what you had to do to get a loan 10 years ago, basically? Prove that you are alive. Okay? I'm not kidding. 10 years ago to get a loan, all you needed to do was basically prove that you can breathe, okay? I mean, all you had to do was be able to breathe. That changed so drastically and quickly, tightening up after the 2009 mortgage meltdown. So the second reason for the drop in the home ownership rate is really high student loan debt. Yeah, that's a contributor. Tuition costs have soared in recent years faster than the rate of inflation. So that means that as soon as a college graduate graduates, that graduate sort of gets trapped, okay? They have to start repaying loans shortly after graduation. So that means that they have to take the first job they can land to repay the bills, okay? Well, when you take the first job that you can land because you need to repay your student loan bill, well, that often is not necessarily a great paying job. But once you get funneled into that, you're into that relatively low paying job. Well, that helps keep them renters, not homeowners. Okay, and then repaying those higher tuition costs, that also means that it's more difficult for them to save enough for a home down payment, okay? Now, they might be able to afford a lower rental security deposit, so they rent, all right? The third reason for this historic drop in the homeownership rate is, it's kind of a psychological one. I mean, millennials went through the trauma of their parents' home being foreclosed upon or short-saled. And, that's embedded in that millennials' memory. Millennials kind of think, hey, we better be non-committal. We saw what happened to our parents. We know what happened to mom and dad. We're going to rent instead. Okay? Or even if mom and dad weren't foreclosed upon, that millennial often saw their parents' home value go underwater where the loan amount was greater than the home's value. And you know what that meant? That made people immobile. They couldn't move. That often means that family is trapped because they can't sell the home and get out from under that loan. They wouldn't be able to pay off the loan. They couldn't move. So that influence, that's embedded in the millennials' memory. All right. A fourth reason that homeownership rates are down so far is, well, because home prices have been on the rise. I mean, that's one simple reason. That hurts affordability, obviously. Home prices have been on the rise, but, there's both good news and bad news there. Nationwide, the median home price, that increased 8% in the second quarter compared to 2014. All right, that's according to the National Association of Realtors. That median home price increased 8% year over year. And you know what that price is now? The median home price in the U.S.? That is $229,400. That's up 8%, all right? First, the good news, higher prices, that increases home equity for homeowners, and that does help keep some owners above water, and it increases their wealth. People with a lot of equity, they're more likely to start small businesses, and they're just a lot more likely to move up the economic ladder. Now, the bad news about higher home prices is that incomes have not kept up with those higher home prices, all right? Wage growth has been slow. Hourly earnings rose just 2% in August from the year before, okay? So I just told you that that's a year-over-year home price increase of 8%, and then you have hourly earnings rising just 2%. Well, that sluggish wage growth, that makes it harder for buyers to enter the market. The market kind of runs away from them, And that's particularly true for first-timers and kind of borderline borrowers, all right? So when you've got home prices that are far outstripping incomes, it takes out that borderline buyer who can qualify for a certain loan and a certain down payment and now no longer can. And if home prices continue to increase, those properties are just no longer affordable for a gradually larger subset of people, okay? Here's the other thing to consider that keeps people from entering the housing market for a first-time home purchase and keeps renters, and that is this. Home prices have recovered kind of unevenly across the housing spectrum, all right? I heard Zillow's chief economist recently discuss how homes in the bottom third of the market, those prices in the bottom third, they are appreciating faster on an annual basis than those home prices at the top third, okay? Now, the top 1%, that might be somewhat different, but we're just talking about homes in the bottom third of the market. They're appreciating faster on an annual basis than those at the top third, okay? Well, at the same time, incomes at the bottom, in that bottom third, that's where incomes are flat and sometimes even declining, where incomes at the top are mildly rising, okay? So low-income households, they dedicate 26 cents of every dollar that they earn on a mortgage. And that's for a bottom-tier home, okay? 26 cents of every dollar. Now, up at the other end of the spectrum, high-income households spend just 12 cents on the dollar for a mortgage on that high-end home, okay? So while low mortgage rates have helped maintain some affordability here, paying more toward housing means cutting back elsewhere, and that's really hurting people at the bottom that are trying to get into that first-time home, and that keeps renters. All right, and home values, hey, they really still have potentially a lot more room to run here in many markets to get back to pre-recession levels. Let's look at how bad it is in a hot market like San Francisco, okay? Not necessarily the place where you're looking for cash flowing rentals. That's where prices are rising among the fastest in the nation and residents are really feeling the pressure. So this is where some markets could be going. Most wouldn't, but existing folks in San Francisco can get crowded out due to rising costs. You've got limited availability of homes or rentals that are even becoming inaccessible to them, okay? Home prices are up 9.5% annually in the city by the Bay, okay? Historically, San Francisco residents already spent 37 cents on the dollar of their incomes on mortgage payments, and right now it's closer to 41 cents. Okay, and if mortgage rates rise, such that the interest rate even goes up to 5%, which is still pretty low, many expect San Francisco residents to have to dedicate 50% of their incomes toward their payments, okay? And this is in one of the most affluent areas of the U.S., all right? I mean, that is getting to be too much. The average worker, they can't sustain that. I mean, what are they going to do? In a hot market, if you want to buy, it's basically like they say, you have to go out and drive until you can afford it, okay? That means you need to drive as far into the suburbs and exurbs as you can until that price becomes affordable to that person. Well, A lot of those people just aren't going to do that. They would rather live close to their job and closer to the city. And that means that they have to rent to make it affordable. And hey, by the way, do you want to know what the current United States rental vacancy rate is? Okay. Now, this is a nationwide number. And of course, we know that markets are local, but this is going to bring you some context. All right. You know, when you run the numbers on a property's profit and loss spreadsheet and you use a certain vacancy figure there when you're analyzing a property, I mean, most typically I use 8% of the rent income as my vacancy rate. I just like that number because 8% is 1/12, which represents 1 month of vacancy per year in a property, okay? Now, some use 10%. You might use 5% in a really tight rental market, although that's not a very conservative number. All right, the national number in the latest quarter ended for the vacancy in rental units nationwide is 6.8%. So it's right in there. And this is what's been tightening up lately. That 6.8% could go down even further if new construction doesn't keep up with that, okay? So as the homeownership rate continues to tick down, we've got fewer homeowners, more renters, and lower rental vacancies. And by the way, in a regional breakdown, if you just want to divide the nation into just 4 general regions, okay, let's take the Northeast, the South, the Midwest, and the West. Today, you find the lowest home ownership numbers in the higher priced markets where you have a lot of population living. In the Northeast, think about the higher priced markets like Boston and New York, Philadelphia to a lesser extent. The home ownership rate in the Northeast is only 60% now. I just told you it's down to 63.4 nationwide, remember? In the West, where you have the high-priced California markets, Seattle, the home ownership rate is now down to 58.5% and plummeting, okay? Now, what do you think is going to happen when higher mortgage interest rates finally kick in, okay? Well, that puts more downward pressure on the home ownership rate, forcing more people into the market to be renters, as well as really helping keep existing renters as renters, okay? So there are a lot of economic and demographic forces out there that look to keep this steady stream of tenants in your property today, with the hope or maybe even the promise here with the way things are going of you having more of that later. So those are some of the demographic forces. Now, what are the psychological forces that keep renters renters, and what makes your renter want to move out and become a buyer next? You're listening to Get Rich Education. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Welcome back to Get Rich Education. People have a choice to either buy a home or rent a home, okay? There are 2 primary choices. I guess being homeless could be a third choice. Maybe increasingly living with their parents is a 4th choice, okay? A 32-year-old might be living with their parents, okay? But for the most part, it's either buy or rent, okay? property values have been on the rise pretty much since 2010 nationally. Now, if real estate prices go down, will rents go down too? Well, maybe, okay? But here's what renters think about when they see real estate prices go down. If values decline, all the renters out there start thinking, well, I'm not going to buy now because the market's declining. I don't want to buy into that. I mean, I'm happier than ever to keep renting. Okay, that's what they think. And this is just kind of the nature of markets in general. You've got the everyday guy that never buys things in the dip like he's supposed to and never sells at the peak like he's supposed to. Okay. You know what the everyday guy that rents thinks? Okay, here's what they do. They kind of read the news articles and, they've got to get used to reading articles for years that say things like, oh, the real estate market is on fire. Values have not been this high in years, okay? They often need to immerse themselves in that media pool for years until they react, okay? So by the time they react, because they've heard so much of this news for a few years, then we're usually approaching a bubble, a high, okay? And that person has that same reaction to stocks, bonds, gold, whatever, all right? So the everyday guy, Joe the plumber, whatever you want to call him, okay, he always acts way too late, all right? That's just nature almost, and it really happens in every cycle, okay? Well, the same thing happens on a downturn. If values are going down, the little guy, and that could be the renter in your apartment or turnkey single family home, okay, that little guy says, well, I'm going to hold out here as a renter longer before I buy so I can see if the market goes back up. And then as things bottom out down at the floor, the psychology of Joe the plumber is that he gets so disheartened by that point with those sinking prices. He loses such enthusiasm right near the bottom of the market, so he doesn't buy right when he should, okay? Or if they're a stock investor, they get so discouraged at the dip that they sell their stock and they lose money, okay? Now, if they're a renter at the housing market bottom, now they really want to cling onto the rental as they've seen housing prices fall around them for years, okay? They cling onto that rental unit tighter and tighter as the housing market goes down, all right? They're kind of happy that they're not caught up in it. So that's what happens, all right? It's only when the market retraces back up again that then they slowly start getting more and more encouraged again. And then after a few years of hearing this, they want to buy again. And then by that point, they've bought high, all right? So whether that's their first home or whether they're buying stocks high again, all right? That's what happens during market cycles, okay? It's almost human nature, really. It just, it really kind of reflects the work of various 19th century European philosophers that first wrote about this. And this is essentially what they coined as the nature of crowds, okay? Well, if you're a real estate investor with cash flow, where your income property's monthly income exceeds its expenses in a sustainable market, well, then you're in a nice position to be above all this kind of cyclical fray, okay? With cash flow, you can weather the storm. You aren't forced to sell at an inopportune time because you're not in any kind of rush to sell a property that pays you every month while you're holding on to it when it houses a tenant that is typically going to have that crowd psychology. So if the market goes down, that little guy in your rental unit is quite happy to rent. You're smarter than the little guy. As a GRE listener, you're more patient. You understand more than them. You plan better. You're better informed and you're more strategic in your decision making, okay? You know to only buy income property that produces positive cash flow from day one. If it doesn't, you typically just want to walk away and look for a smarter deal because you can find it, all right? Because, predicting cash flow from a property, I mean, that's something that's fairly reliable, okay? It's quite dependable. compared to trying to predict price appreciation. All right. There really isn't anyone that can do that. All right. So when housing affordability is low and it's getting low and it keeps getting lower lately, meaning prices are higher. Okay. So affordability is lower. And you often see this upward pressure on rents that we're seeing in a lot of markets. Now, when lending guidelines are stiff, like they are now, they're really rigid, you also see upward pressure on rents. So even though interest rates are low, low rates, they just don't help that renter that wants to qualify to buy their first home because they can't put together a down payment and a financial life to qualify. Okay, that renter is frustrated, okay? He can't reach those low rates that he can see on the other side of that tall lending hurdle over there, all right? Non-qualification for that renter to become a buyer, that results in higher rents and higher rental occupancy. So, you yourself, do you want to see lending standards loosen up? Well, it might make it easier for you to qualify for more income property yourself, but what it also does, then it makes it easier for your tenant to qualify and move out, all right? So again, you can take advantage of this because you're a listener, you're informed, you've learned the strategies for qualifying. Your renter is not a get-rich education listener. They're not learning about those tactics, okay? And we discussed some of those tactics in episode 40. Now, if you already own lots of rental real estate, you really want to see lending standards stay stringent like they are, and you might even want interest rates to go up sky high if you've already bought your real estate, because that makes it super tough for your renter to become a buyer, and you've already locked in your, kind of superior, lofty position, okay? Almost a commanding position that you've got there. You're in control. Your cash flow is better than ever. You can do a cash out refi to buy more property, yet hold on to that cash flowing property at the same time, even if it lost value. You could still have monthly cash flow if it lost value, okay? Or you can sell with the tax-free capital gain and 1031 exchange out into something even more profitable, moving your equity along, increasing your velocity of money. You're in a great position, okay? Hey, well, speaking of people that are in a great position through real estate investing, let's catch up with Maverick Investor Group's Matt Bowles for just a few minutes on something that you can make actionable. Hey, well, I'd like to welcome back onto the show Maverick Investor Group's Matt Bowles.
Hey, Keith, great to be back.
Hey, Matt, I look to Maverick as being really one of the preeminent resources in identifying the best, most investor advantage markets in the United States. So what do you have coming up for that, for an opportunity that my listeners might be able to get in on?
Well, Keith, the best markets change over time. And what we're really excited about right now at this particular historic moment is what's going on in the Kansas City real estate market. One of the things that really jumped off the page to us about Kansas City is that the rents have increased 8.5% in the last year. Okay, that puts it in the top 5 markets in the country for rental increases. And so you have a situation where the rents have gone up and the home prices are still relatively low. There's still a ways to go in the home price recovery cycle. And so it's really creating optimal cash flow margins for real estate investors right now. Overlay that with the fact that there are multiple, as in numerous billion-dollar development projects that are going on in Kansas City right now, including one by the Cerner Corporation, which has already broken ground. It's anticipated to create over 16,000 jobs and a few others around the city as well. So really exciting energy going on there right now, and a really exciting moment for real estate investors to get in and take advantage of that.
Yeah, that could really exploit a better rent-to-value ratio if we've had a rent run-up like that, and yet the prices for the properties haven't run up yet. Now, as far as what's going on with the economy locally, didn't I read that Warren Buffett is making a significant investment there in Kansas City too?
Yeah, well, Berkshire Hathaway, absolutely. They've invested in they're going in on the railway, and the railways are using Kansas City as a center point for shipping things to different points in the country. So the company that Berkshire Hathaway is invested in is anchoring one of the developments there in Kansas City relating to the railway transportation. So a lot of really, really exciting stuff, and really big time investors definitely looking at Kansas City.
All right. And what are we looking at for numbers there as far as purchase prices, cap rates, maybe prospective cash flow, and so on?
Yeah, absolutely. So we're talking about single family homes in the probably $75,000, $85,000 range. Now, some of them may be a little bit higher, but that's about the average, I would say. And in that price point, you're looking at probably around, at this moment, about a 9.5% capitalization rate. And again, the way that we calculate a cap rate includes a vacancy factor and a maintenance factor estimated in there. So about a 7% vacancy and about a 5% maintenance assumption, you're still coming out with about a 9.5 cap rate in Kansas City. That's how compelling those price to rent ratios are right now.
My gosh, like in my own market, to get a 9.5% cap rate, I'd need to buy a 20-plex.
Yeah.
Okay? That just doesn't work everywhere. And I'm really glad that you brought up how you calculate the cap rate, because when I first got into turnkey real estate investing, I was looking at providers and looking at their numbers and how they calculate their cap rate and their cash on cash return. It included 0 vacancy and 0 for maintenance. They just weren't part of the calculation. So that's not an honest number for the cap rate, and yours is.
Absolutely. It's really important. Always, always, always look at how that's calculated and develop your own. Ideally, you want to develop your own set of financial calculations. And then every property you look at, just make sure you're calculating it the same way. Don't rely on somebody else's cap rate or ROI or any other type of calculation. Make sure you know exactly what the numbers are yourself.
Listeners, remember your VIMTIM from a previous episode. I think everyone remembers that they have a mortgage expense on a leveraged property, but after that, VIMTM is your vacancy, insurance, maintenance, taxes, and management. Be sure to account for all that. So Matt, how do my listeners find out more about the Kansas City opportunity?
Well, Keith, they can register for a private buying opportunity webinar that we're going to have coming up, and I will let you give them the exact link where they can go to register for that. But what we're going to do is an educational webinar about the market. So we're going to show much more detail about all the stuff that's going on in the market and why it's very advantageous for investors at this historical moment. And then we're also going to offer a private buying opportunity for turnkey performing rental property in the Kansas City market that folks can buy no matter where they live, because it's going to be for fully renovated property that's already got tenants and local property management in place, so they can own in the Kansas City market regardless of where they live. And I'm going to let you give them the exact link and details for how to register for that, Keith.
Yeah, and if you're interested in that opportunity and getting the link to that webinar, it's a webinar format, so you can ask questions and so on. Just go ahead and subscribe to our newsletter at getricheducation.com, and I will be sure that you are sent the link. Matt Bowles, thanks so much for coming back. It's valuable every time you come onto the show.
Hey, thanks so much for having me, Keith.
Maverick Investor Group's Matt Bowles really knows real estate investing, and he knows about the best real estate investing markets and that they change over time, just like we discussed on the last episode. That's just a reasonable, rational way to approach investing. Don't get emotional. Don't get tied to one market over the very long term, okay? Those sort of feelings are for your home that you live in, but they just don't really have a place in investing. Draw the emotional line there, all right? It's kind of like the Robert Helms quote, live where you want to live and invest where the numbers make sense. Okay, there's no quote about live where you want to live and you have to invest there too, okay? Then you're exposed to just one market, and that's what gets risky. All of my apologies to your local real estate agent that always says it's a good time to buy in their market, okay? Actually, maybe no apologies to that mindset, okay? They're not looking out for your best interest in that case. They're always trying to promote their one market, okay? Matt Bowles will be appearing live with you on that upcoming Kansas City webinar. so you'll be able to ask Matt any questions in real time with the other attendees if you so wish to. For that webinar link, just subscribe to our newsletter at GetRichEducation.com. Let us know where to send the link in a few weeks when that webinar occurs. We'll send it to you a few days beforehand. I don't think it's ever been that easy for you. You know, our existing newsletter subscribers took advantage of an invitation to a prior Kansas City webinar with Maverick about 2 months ago, and they're getting to know what it's like to own cash flowing real estate in a sustainable market. So don't pay the opportunity cost of missing out. Last week, our existing newsletter subscribers learned a fun, actionable, measurable way to learn how to invest in yourself and what that really means. I wrote that one myself. Hey, so one last time, for private buying opportunities not available to the general public, to get all the Maverick webinars for property representing some of the best U.S. cash flow markets, just subscribe to our friendly newsletter at GetRichEducation.com. Once you subscribe there, go out and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.